From an income tax standpoint, sole proprietorships, they're the easiest one of the bunch because A, they're easy, and B, there's certain taxing things that can come out of it. The problem is sole proprietorships have this nasty thing called self-employment tax, which is basically Social Security and Medicare tax that everybody pays when they have a job. They pay into those funds. Generally, it's 7.65% from the employee, and then there's an employee match of 7.65%. Also, in total, it's 15.3%. Just a nice round number is 15%. And so that tax can add up really quickly for people. And oftentimes I've seen over the years where the self-employment tax, also known as SE tax, is higher than a person's income tax on their returns, depending upon how everything else shakes out. So it's something that we watch extensively. Various things. So one of the things is the home office deduction. A home office deduction within an S-Corp is much more difficult to get than a sole proprietorship. One of the areas. Another area is in the retirement plan area. Because all dollars within a sole proprietorship are considered self-employment taxed income, then potentially more dollars are available to you for the various retirement pieces that are out there. SEP IRAs or SE self-employed persons IRAs and the percentages that go into that. There's simple plans, there's 401ks. All of those things can need to be looked at when you do it. But all in all, I'm just to kind of cut to the chase. Personally, I don't really consider switching from a sole proprietorship to like an S corporation until they get in that $22,000 to $25,000 of income range in a year, because there is some additional cost to an S corporation. There is an additional income tax return that needs to be done. So there's that cost. And then there's quarterly payroll tax returns that must be filed for the business now. When you elect S corporation status, you automatically become an employee of your business. That requires you to have a W-2, payroll taxes, a payroll amount that you're paying yourself. That payroll is supposed to be effectively what would it cost you pay for somebody else to do your job. So for example, let's say you unfortunately become injured or disabled or something, so you have to go pay somebody else to come do your job to keep your business going. What would that be? That's what the definition kind of is. So we kind of target that, but you can't just say I'm going to pay myself $1 and take everything else in distributions. You have to pay yourself a fair wage. You're a business owner. Slight definition change, but like for myself, I'm an S corporation, and it's kind of a me and myself and I type thing. So yes, I'm self-employed in one sense, but from a taxability sense, there are changes. If it's just you, like I said, it's the question. If you're going to make more than $25,000, then it will be a significant change. So I have an example. So let's just say, for simplicity purposes, a business makes in total, before paying any wages to the owner, $100,000 straight. Because of the self-employment tax, that's 15.3%. Or that's $15,300 in self-employment taxes that will need to be paid on all the income of the business straight. And then in addition to that, you've got income taxes to be paid. From the S corporation, you still have $100,000. Now, the S corporation does not pay any income tax. It has a 1120S form that it makes and is filed with the IRS. A K-1 is generated for the individual. I compare a K-1 to a bank that sends you, the individual, a 1099 interest on the savings account that you have. So if you have $10,000 in a savings account, you've made $100 an interest in the year. Obviously, the bank's not paying any income tax on that money. It sends you a form. You report that $100 on your personal income tax return, and it's yours. Whether you take the money out of the savings account or not, you still pay income tax on that money. You now have rights to that $10,100. You could take that out at any point in time. Whether you choose to or not is up to you. Same thing with an S corporation. S corporation, it makes money, and then you have rights to its profits. Whether you take that money out or not, you as an individual are still going to have to pay income taxes on that money. Where it changes from a sole proprietorship, again, we said like the $100,000. Let's just say that we take half of that money in a wage, so $50,000. That money is subject to FICA and Medicare tax or self-employment tax, same number, okay? That's $7,650 is what that number is. But then you have the additional $50,000 that's sitting out there. You'll have to pay income tax on that additional $50,000. You just won't have to pay tax on that money. So by switching to the S corporation in this example, you're going to save, $7,500. And there are a few costs that go into this. So because you have wages, you have unemployment taxes to pay on your wages, both federal and state. There is an additional tax return that has to be filed for the business, all those things. So that is additional thing, but I will guarantee you that you will save quite a bit of money by switching to S corporation. The reason why I say the $25,000 of profit from a business is because below that, it's really hard to justify. If you're full-time, you're going to have to pay yourself a wage of $18,000, $20,000. And so that little bit of difference, $5,000 that's left over, and the savings of that, 15% of $5,000 is $750. Trust me. And fees and other services and stuff that you have to do, that price will be eaten up quickly.